My name is Mark O'Reilly and welcome to this episode of Insurable Risk. Today we're going to be talking to you about how to get your insurance program to represent your need. The most important part to that is making sure that we achieve the principle of the insurance transaction, which is to make sure that the insurance program puts you back in the same position you're in as if the loss didn't occur. Without that provision, you're really wasting your money. So how do we go about making sure that this doesn't happen to you? Making sure that your insurance program is going to achieve your desired effect. So what we really look for, first of all, is 3 key points. If you remember these 3 key points, and when you're reviewing your insurance program, you'll end up with the right idea. We look, first of all, at the financial strength of the insurer, the quality of the brand, the name behind that. Second of all is making sure that the coverage afforded to you actually represents your needs. And us as experts in the accommodation sector are able to design a program that meets your needs, and we'll touch on that in a minute. The third part is the claims paying ability of the insurer. They're there to actually help you in your time of need and provide their expertise to your industry, which is why we choose certain insurers. Just a comment on price. Everybody looks at price. Price is important. But the reality of it is, at your time of loss, when you actually need your insurance to respond, no one ever remembers price. All you remember is the quality of the insurance program and the service that the insurer is able to provide you to help you in your time of need. So let's get back to how to assess your insurance program. 3 critical questions to ask anytime you look at it. Is the insurance an economical transaction? Meaning, is it cost effective? You can insure anything in reality, but it must be a viable transfer of risk from you to the insurer at a cost-effective basis. Will the insurance put you back in the same position? The reality to it is that is our job, to make sure we're assessing your risks and making sure the insurance program meets your needs, so you get that trust and faith that it's going to achieve that result. The third part, again, it's not about price, it's all about protection. If you think of insurance as protection to help you sleep easy at night because you're buying a piece of paper that is a promise that if something happens, someone will pay you a degree of money. That's what protection is all about, and that's what insurance should be achieving for you. Don't look at it as a price transaction, look at it as a protection mechanism. So, let's move on, and as we delve deeper into what insurance really is. Let's look at the pillars supporting your program of insurance. First of all, we'll look at the 4 key pillars that are holding up the whole program. Your general insurance, your property style insurance program. Your health and well-being are critical. Most people go out and buy health insurance to protect that. The third part is the life insurance component. All of these are headlines, and there's a whole lot of impacts in behind it. The fourth part is superannuation. Because that's, again, you're paying some money to get some money back at the end of your life to protect your financial strength. The emerging risk that we're seeing coming out is also cybercrime. What's going on the internet is a number of fraud aspects, and you also need to have a pillar that protects your internet-based usage, particularly with the number of booking transactions, for example. All of a sudden you can be hacked, so that's why we've put that up there. So let's delve more into the general insurance space. How do we go about assessing your risks and buying an economical insurance program for you? Let's bring up some risk quadrants for you to have a look at. There's 4 risk quadrants. Just so you can understand, we have a probability of loss and a cost scale. Probability means you have the opportunity of having 1 insurable event this year, for example, or you may have 5 claims or insurable events this year. The cost scale of those claims may be small or may be large, so that's the scaling effect. What you've got to understand is this low cost, low probability issue, essentially you can afford that yourself. So why would you pay money to an insurance company for them to only give that back to you at that basis? That's a dollar swapping area, it's not worth it, and we then educate you, aim to educate you I should say, to get that right for you. So you really shouldn't be buying insurance here, you're buying insurance in the other quadrant. High probability, low cost. There's an argument if there is a high probability but a very low cost, if it's not a cost impact to you and your business, do you need to insure that? That's the grey area that we've got to talk through. Low probability and a high cost, meaning you can't afford that loss to occur and self-insure it. or absorb that cost into your business. So that's an area that we absolutely must insure. And then you get to the fourth quadrant, high probability, high cost. Well, then that's something that you generally can't afford in your business and you know it's likely to happen. So generally it's an economical transfer of risk onto the insurance company for that area. So when we design an insurance program, we look at your risk in a quadrant basis so you understand how we can best organise that economical transaction for you. As we move on, what we're trying to avoid by making sure your insurance represents the right area is all of a sudden something happens and you and your business are safe, we have an insurance benefit for you, and you're not a forced seller. If we get it wrong, that's what can end up happening. So let's delve into it a little bit further of how we actually go about designing a program. What we start with is what we refer to as the hazard index. The insurance program has a number of different features, or I can use that term pillars that we've been talking about. We've got material damage here. This is a categorisation. Graphically, it's out of 100. So the highest risk for the accommodation sector we see is the material damage, particularly the business interruption. A number of businesses don't insure the economical loss, and that's what business interruption is. As you can see, that's much higher than the direct assets, and that's why we feel it's so important. Also rating highly is your liability, because you've got a number of people walking through your business and therefore very high liability exposure. So when you're looking at your insurance as a program, this is the style of risks that you have to match off in that program, and we can help you work your way through that. So let's go to a couple of steps to how to make sure that we get that right. First and foremost, and I'll talk about this in a minute, is setting the sum insured. Most important thing is making sure the limits are right. We have a very broad-based insurance program. We've already been to the market and negotiated this on your behalf to make sure you get the best available cover for you. So that's our job to do that for you. The third part is a business continuity plan. It's a what-if scenario. If you have a loss, what are you going to do? If you spend a great deal of time developing a business continuity plan, you'll actually be substantially better off in the event of a loss. So prepare and be ready just in case. That's what risk is all about. Now, risk tolerance is about what you can afford versus what you can't afford. Only insure for what you can't afford. If you can afford it, there's no need to have insurance for that. So let's delve into setting the limits. First and foremost, a lot of people will look at purely the replacement value of that asset. As you can see here, there's a lot more to that, and quite quickly, if you can just do some quick sums, all of these other benefits as a percentage of that would suggest if you only allow for the replacement value, you're substantially underinsured. Again, getting back to the principle of what we're trying to achieve here, to put you back in the same position, setting your insurance limits must take into account all of the financial exposures that can impact you and the replacement of your lifestyle, your asset. So when we go through it, we also look at the make safe, the removal of debris, the extra costs involved, any escalations, particularly getting external assistance. So let's move on to the business interruption side, the financial loss. How do you set that? First and foremost, the insurance has got to be a worst case scenario. What is your worst case that you're trying to get the insurance to match off with? What we look at here is just a quick scenario that we work through with our clients. They're trying to understand their financial model and provide the insurance program to put them back. So first of all, what a lot of people do, again getting back to that building cost, a lot of people only look at this construction time. The reality to it is there is a lot of other time-based aspects that prevent you even getting to this construction time. As you can see, it's quite a way down the list. So what you've got to look at when you're assessing the time and work through a model so you can look at what is the maximum exposure to actually get to the rebuilding time. So in total, there we're looking at essentially a couple of years, which is vital. Anything by way of 6 months, 8 months, 12 months, generally in my view, may not be adequate. So we've got to look at it in a model formula for you to help you understand it better. So what's my job for you? Our job as brokers is to provide a free review. We'll go through your program, we'll tell you what's right, what's wrong, and we'll help you improve that. That's at no cost to you, and the benefit to you is absolutely enormous. If you get your insurance right and achieves the principle of what you're trying to get that financial transaction, the money, you're spending your money, it's not about price, it's about cover. So that's what we're all about. So the benefit for you is $50 back. If we cannot beat a current program and give you better advice, better cover, as well as price, we'll give you $50 back. That's how certain we are of our service and our quality that we put into your program to make sure your risks are met. So let's just round this off with a couple of quick tips. First and foremost, you must review the wording. The wording is a critical aspect. Again, it's not about price, it's about the cover and the wording. Second of all, your risk tolerance. Don't buy a program that has a very low excess. In this case, I've just put up the example, $250 or $500. What is your true level of risk that you can afford, and what is that level of risk that you cannot afford? You only insure for what you cannot afford, and that's a way to review your program and maybe save some money. Third, get a free insurance health check. That's my job to help you with that. Fourth, include cover for financial loss, your business interruption. As you saw on the hazard index, we rate that as your highest exposure, and the opportunity to that is if you get it wrong, you're going to be out of business. So it's our job to make sure we get that right for you. 5, review the named insured and the business description. It amazes me the number of reviews that we do that this one ends up being the top priority. We've actually done the whole insurance program, but the name is wrong because it's in a superannuation fund or the assets are held by another party. We must get the insurable interest correct before we even delve into price. So, just to sum up, will your insurance put you back in the same position? Let's go back to the principle. I hope that this has been helpful to you, and I hope you've got something out of it. Look forward to speaking soon. Thank you.